Hello, everyone. This is Cathie Wood at ARK Invest. It's Employment Friday, and so we usually like to give you a rundown on what we're thinking, what we don't think is being highlighted enough in the media, and perhaps some insights from our analyst and our director of research on everything innovation. So as usual, we'll start with monetary policy, then fiscal policy, economic indicators, market signals, and then we'll end up talking a little bit about innovation solving even more of our problems. So monetary policy, M2 growth, still slowing down. It peaked, I think, in February at 27%. And is now down to about 12%. Now that's higher than it was pre-pandemic. Back then it was in the 3 to 6 or 7% range. So still quite a bit higher. Quantitative easing still is in place. The Fed did say this week that it's looking to taper, but we've gotten some signals this week that may have the Fed reassessing how quickly it will taper. Employment today was one of them. Retail sales over the last few weeks, disappointing. And in particular, auto sales. We'll get into that in a minute. On the fiscal policy front, well, the $3.5 trillion package is being debated in the House. And I think we got a signal from Senator Manchin of West Virginia this week that and he has a very important vote in the Senate, he thinks $3.5 trillion is just ridiculous, given that debt to GDP ratio, government debt to GDP ratio in the United States has already passed 100%. Before the pandemic, we were in the 75-80% range. So 100% is quite the marker. And he's also concerned about inflation and that a fiscal package of that magnitude might aggravate some of the inflation indicators that have been flashing red recently. I think that's a very good thing. If he is not for this package, it's not going to pass. I think he's much more for the $500 to $1 trillion pure infrastructure package. We'll see what happens. We do know that this $3.5 trillion is filled with tax increases. Tax increases, I would say, on the biggest job creators out there. That's problematic for those who are worried about the employment situation. It also it includes another tax that I actually thought we'd see much sooner than now, a carbon tax, or a number of different carbon taxes. And we may end up seeing a tax like that. It is a very broad-based tax. It's very regressive, so we'd have to put in place some credits for lower income individuals. But for those who are concerned about the environment, this might be an acceptable tax to pay for perhaps the infrastructure program that hopefully goes through. I think with midterm elections on the way, I mean, the campaign season in some states has already started and will intensify. I'd be shocked if we'd get many lawmakers pounding the table saying we have to have these tax increases. So we'll see. Nancy Pelosi wants the $3.5 trillion before we get to the real infrastructure bill. And this is a setup for a bit of a boxing match, I would say. Okay, so on to the economy. Today, we got an employment report that was very weak relative to expectations. 235,000 increase in non-farm payrolls. The expectation, I think, was around 733,000. And last month, it was revised up to over 1 million. Now, we're trying to figure out, okay, what is happening here? Is it because of the Delta variant of the coronavirus and the pulling back of activity associated with that? Well, I guess this report corroborates that because leisure and hospitality employment was flat. And those numbers had been coming back very, very strongly until this month. So that's a probable reason. Is it because of supply chain issues? We're hearing about shortages, especially chip-related shortages, chips that go into everything manufacturing. Well, here too, we have some clues. Manufacturing hours worked were down 0.5%, which is a very big drop month to month. That's about 6% when you annualize it. So again, a big drop in a real indicator, not being influenced by inflation. Construction employment was also down. Again, there could be supply chain issues there. So we've got Delta, we've got supply chain issues. And then the third question is the economy in an underlying sense beginning to weaken here, away from the Delta variant and the supply chain issues? Well, what I'd like to do in the next couple of minutes is give you what we're seeing in terms of strong economic indicators and what we're seeing in terms of weak economic indicators, and a hypothesis that, yes, the underlying economy is beginning to weaken in a fundamental sense. But on the positive side, there's a measure called JOLTS, which is job openings. That measure crossed 10 million. There are 10 million jobs out in the U.S. market that are unfilled today. Now, why is that? There are any of a number of reasons. One is these jobs don't pay enough. And you did see Walmart this week increase pay, I think, another $1. I think they're going to something north of $16 for I think it was 500,000 of their employees. So yes, low wages is one. Skill set mismatch is another. And of course, as technology is evolving faster and faster through our lives, this is becoming a bigger problem. We do believe that corporations are going to have to start training and bringing in some of these people who do not have those skills. We've seen corroborating the strong employment report, initial unemployment claims have come down pretty much week by week. So they peaked, just for perspective, at 6.1 million claims at the worst of the coronavirus last spring. And now we're down to 340,000, huge improvement. We're not that far above where we were pre-coronavirus. So the 250,000 range. So we're getting back to normal, lots of improvement there. In the personal income report, we saw a 1.1% increase in personal income. Nice increase. We saw the saving rate go up to close to 13%, I think, if I'm not mistaken. And so that threshold for the savings rate, before the coronavirus, it was in the 7 to 8% range. We're still well above that. So that's consumer firepower that is available. We're seeing in the housing sector, good sales, both new and existing home sales, very good. Although I will say that in the new home sales report, the month's supply of inventory effectively has started to creep up. So that's an interesting nuance. The pricing in housing has been extremely strong. And there's been a little bit, I would say, of a panic buying in some parts of the country. Because supply has been so tight. And if the month supply now are starting to increase, that will cure the pricing problem, we think. The Purchasing Managers Index was very strong for August. Orders booming, up at 66.7, and that was an increase from prior months. So it's been levitating for quite some time now, as businesses have been scrambling to keep to catch up to consumer demand as their shelves started emptying out. They were way behind the consumer, as I've mentioned on this video, really starting before the coronavirus. They were pulling back on inventory growth and pulling back on capital spending because of an inverted yield curve in 2019 and the China-US trade conflict and saber rattling. So before the coronaviruses, businesses were postured very conservatively. The coronavirus hit, bam, they shut down. Just as with PPP checks, the consumer opened her pocketbook and started spending on goods and started spending at a very rapid clip. Now, I've mentioned before that goods are only 1/3 of total consumption, and that's all that consumers could spend on, as most services were shut down. So disproportionate spending on the goods side, and businesses have been scrambling to catch up ever since. We are also seeing them trying to catch up on the capital spending side. So non-defense capital goods, ex-aircraft, a really good leading indicator of capital spending, is very strong. Not surprisingly, we're seeing a shift towards technology spending to increase productivity and to get in tune with the digital age, now that we're probably all going to be working on more of a hybrid schedule. So industrial production, very strong, 1.1%, or 1.4% in the manufacturing sector in the last report. So businesses probably are catching up with demand, maybe a little bit too much so. So those are the positive indicators that we've seen in the last month. The negative indicators are quite instructive. First, the University of Michigan Consumer Sentiment Index dropped precipitously back to a level we hadn't seen since 2011, when we were grappling with a European sovereign debt crisis and fears that we'd end up in another 08-09. So that's a big drop. We're also we saw retail sales drop 1.1%, and that is a nominal number, which means it includes inflation. The CPI inflation was 0.5 that month. So in real terms, the drop in retail sales was probably closer to 1.5%. Sequentially. That's a huge, huge drop in 1 month's time. Now, why is this happening? I think what we're seeing in the survey is consumers' inflation expectations are going up, and they're feeling that they're losing purchasing power. If you look at real average hourly earnings, so taking out the inflation bump, real average hourly earnings on a year-over-year basis are down 1.2%. So the consumer viscerally feels that, probably looking at the gas pump in California, which I believe is back over $5 as it is elsewhere in the country, and food prices because of supply chain issues also rising rapidly. I think one of the most surprising numbers that I saw during this last month, and a continuation of a trend, or what seems to be a trend developing, auto sales. Auto sales peaked at 18.5 million units in February, I believe. And as of August, we just got this number this week, they've dropped to 13 million units. Now, that's at an annual rate, and that's a U.S.-only number. That is a 30% decline, and that's not annualized. If we annualized it, it'd be like a 60% decline. Now, the auto manufacturers are blaming chip shortages, and the chip shortages are real. We know that. Technology spending has taken off, and most technology requires chips. But I do not believe that the auto market has truly weakened that much. I think what's beginning to happen is consumers having bought a lot of cars in the last year to avoid mass transit, a lot of them being used. They're now sitting back and saying, okay, I've already got my car. So the inventory is not on the dealer lots. Many people were quick to tell me on Twitter that couldn't I see the dealer lots are empty? Of course. There's a chip shortage. But maybe the inventory is in the consumer's driveway or garage. That's one thing that we think could be the case. Or maybe consumers are saying, for my next purchase, given the total cost of ownership has come down and is now below where gas-powered vehicles are, maybe I will buy an electric vehicle. And so there could be a pause in auto buying because of the technology shift that is underway. We believe that electric vehicle sales are very strong right now. Certainly Tesla's last report suggested so. And it could be that there's a shortage of electric vehicles, but we would not be surprised if there is a brewing inventory buildup in gas-powered vehicles. They may not be in the dealer lots. They're probably in the garages or driveways of consumers. And I do think there's a reassessment on the part of consumers, especially because sticker prices are falling so rapidly in the electric vehicle space. And we're seeing more subsidies, which in some states means that the sticker price or the price for an electric vehicle is now below the price for a like-for-like gas-powered vehicle. And as you know, we have been saying for quite some time, based on Sam Corris's work and Tasha Keeney's work in electric vehicles, autonomous vehicles, we have been saying for some time that we believe electric vehicle sales will scale from 2.2 million last year to 40 million in 2025. And our early estimates for this year are something in the 3.6 to 3.8 million range. So think about that. You've got auto sales in total dropping from 8.5 million at an annualized rate to 13, while electric vehicles are up roughly at 50% or more. So I think there's something going on out there with gas-powered vehicles. We will get confirmation on this, and in some ways we are already starting through the Manheim Used Car Index. The Manheim Used Car Index shot up last year 61%. Again, consumers were scrambling to get cars, used or otherwise, to avoid mass transit. So big burst there. It peaked in the Manheim Index peaked in May at roughly 200. It's down to 193.7 right now. These are biweekly numbers. We have them through mid-August. So we'll see what happens with the next report. If there truly is a chip shortage, and that is the reason and the only reason that auto sales are down this much, then the Manheim Used Car Index price should go up again. If it continues to go down, we believe that this brewing theory about gas powered to electric accelerating here is probably correct. We're also seeing some inventory numbers that would say that businesses are catching up with consumers. We saw the business inventories altogether, I think this was the month of July, up 0.8%. And that is in addition to this concept that there are a lot of inventories in our homes. Think about Clorox. Clorox is announcing big disappointments in sales. Not surprising. I think their peak quarter growth rate last year was 27% growth on a year-over-year basis. Now, this is the kind of item that grows maybe 1.5%, maybe 2% if you include the emerging markets. But we're now seeing outright declines, and it's because there's so much inventory in our homes. Not surprising. And as I mentioned before, consumers spent a disproportionate amount of their income on goods, which are only 1/3 of the market basket. And now there's been a lot of pent-up demand for services. So I think there's a share shift taking place there, which could cause some real inventory problems. Now on to the markets. What's the fixed income market telling us? Fixed income market's not worried about inflation. And we've gotten some pretty heady numbers on inflation because of these supply chain problems and so forth. But the fixed income markets are not worried about inflation. And they're not worried about credit problems brewing out there. That's what we think will change. If we're right, and we think the auto sector will be one of the first places that will see this. If we are right, then the spread between treasuries and auto yields is probably going to start widening. That would be another clue that we are correct. Commodity markets, what are they suggesting? Well, the CRB, the Commodity Research Bureau Index, so it's a broad-based index, but heavily weighted to energy, is starting to tip over. Lumber prices, since the last time I did this video, are down even more. They peaked at 1711 on whatever the metric is. They're down to roughly $500. They got as low as 426, I believe, recently. Copper prices are down from 490. I think we're at 440 now. We're also seeing some early signs, even in the chip space, that there might be some excesses developing there. So Frank Downing, one of our fintech analysts, he's an Ether miner. He watches NVIDIA's RTX 3070 chip. It's a gaming chip, very closely in terms of pricing to gauge what's going on in both the gaming world, but also the world of Ethereum. And he mentioned that prices there peaked out at $1,421 in May. They dropped to $1,065 in July. They popped in August in tandem with crypto prices, so but are still below that peak. And the manufacturer suggested retail price for that chip is $500. So still elevated there, but a change in a price signal potentially. We also noted with interest that NXP's CEO and CFO sold some of their shares not on plan. So this was a deliberate sell. Did they see something? They're very heavily weighted to autos. Do they see something out there in the auto world from a chip point of view that is changing? My guess is they do. The dollar has been stronger than I think a lot of people expected. That would be consistent with commodity prices coming down and inflation risks going down as well. Equities. Okay, so we've had a rotation. We came into the year with growth flying, and then we moved into a cyclical value market from mid-February to mid-May. And then we moved into a kind of a diversified market, but we've seen very recently a move into defensive names. The real estate sector, the FANGs have become very defensive stocks. So they've had a very nice run here. So growth, value, defensive. We really do believe that we're setting up for growth and particularly for innovation to take off again. Now, why are we saying this? Well, innovation solves problems. And we saw what happened in the coronavirus crisis. Innovation took off, and we've talked a lot about it. And we've moved into much more of a digital world, much faster than otherwise would have been the case. Well, what are the problems now? Well, price increases are a problem, and consumers don't like them. So innovation does solve problems. I mentioned the electric vehicles. They're coming down in price, and they're better performing cars. They're better for the environment and so forth. So we believe the price decline associated with EVs is going to help solve the auto pricing problem. Cryptocurrencies have taken off as inflation fears have flamed. Crypto is a better hedge. Bitcoin in particular is a better hedge against inflation, if that's the fear, than gold. Gold supplies will continue to increase over time as Bitcoin's supply starts to diminish in terms of the rate of increase. We're also seeing DeFi in the Ethereum world solve problems. The problem that other people have is they can't find enough yield in cash and bonds and so forth. And so the DeFi space is providing 3 to 4% yields where no other place is. Now, you might say that's not a very safe place, but I think a lot of young people are flocking to it. And probably one of the biggest surprises we think that is brewing in the next 3 to 5 years, but we're beginning to see incredible progress now in terms of cost declines, is in healthcare. DNA sequencing costs are plummeting, and innovation is pushing them faster. And I think the other thing that's happening is artificial intelligence training costs are dropping, according to William Summerlin, our analyst, 68% per year. So if the cost of something very important like AI, which is going to go everywhere, is dropping 68% a year, we're going to get more of it. And the world's going to change that much more quickly. He and Simon Barnett, Ali Ehrman, and Pierce on our genomics team are doing a lot of work together on how this is going to drive down molecular diagnostic testing costs, and especially when it comes to cancer screening and so forth. So we're going to solve a huge number of problems as costs are coming down. And even more important in healthcare, we are able, finally, thanks to the convergence of DNA sequencing, artificial intelligence, and gene editing and other gene therapies, we are able to identify mutations, which are the earliest manifestation of disease, in the 3 billion letters, or 6 billion if you consider the base pairs, in each of our genomic profiles. We're able to find that needle in the haystack now. What's mutating? Why do I feel this way? And what has gone wrong? And with AI and gene editing, we're seeing the promise of outright cures. We've seen cures in sickle cell disease, beta thalassemia, and another ATTR, another blood-related disease. These are outright cures. Very early days, but this is the promise. And think about how many healthcare dollars are tied up in chronic diseases. We're seeing companies like CRISPR Therapeutics and Vertex working with gene editing to cure diabetes, which is from a chronic set of conditions, one of the biggest budget busters of all. So under the leadership of Brett Winton, our amazing director of research, our analysts are evolving their research to find out just exactly how innovation is going to solve the problems we're facing. And I'll go back one more time to electric vehicles and all the work that Sam and Tasha have done on them. What is one of the most visible price increases we're seeing right now? It's not just used car prices. Those are up 60%. It's oil prices. What better solution than an electric vehicle? I haven't had to go to the gas station since September of 2018, since I got my Model 3, and I don't miss it at all. So anyway, looking forward to your comments and suggestions, and looking forward to another month rich with data, and another month full of research around innovation by ARK, and we give it all away. So stay tuned, arkinvest.com. Thanks so much.